Imagine owing so much money that even the interest payments alone are bigger than your salary. Now imagine that not as a person, but as a country. That's exactly where the United States of America stands today. The U.S. national debt has crossed $35 trillion, and it's growing faster than at any point in history, every single second. The number on the US debt clock ticks higher: $10,000, 20,000, 100,000, and there's no sign of stopping. Most people hear national debt and tune out. It sounds abstract, far away, like something politicians in Washington worry about. But this time it's different. Because this debt isn't just a number, it's a ticking time bomb that affects global markets, inflation, interest rates, and even the value of your savings. Let's start from the beginning. How did the richest country on Earth get buried under so much debt? The answer lies in decades of overspending, undertaxing, and financial denial. For years, America has spent more than it earns on wars, welfare, healthcare, and interest payments themselves. Every year, the government runs what's called a deficit, meaning it borrows money to fill the gap between what it collects in taxes and what it spends. And just like any loan, the more you borrow, the more interest you have to pay. For a while, that seemed fine. Interest rates were near zero, borrowing was cheap, and investors around the world were eager to buy U.S. Treasury bonds, the safest asset on earth. But things have changed. After years of inflation and aggressive rate hikes by the Federal Reserve, the cost of borrowing has exploded. Now, America is paying over $1 trillion a year just in interest. That's more than it spends on its entire military. Let that sink in. The United States now pays more to service its debt than to fund the Pentagon. It's like using one credit card to pay off another and hoping no one notices. But the world is starting to notice. Credit rating agencies like Fitch and Moody's have already issued warnings. Foreign countries like China and Japan, once the largest holders of U.S. debt, are quietly selling off their treasuries. And investors are asking the question no one wanted to ask: what happens if the United States can't pay? Now, technically, the US can always print more dollars to cover its obligations. The dollar is the world's reserve currency, and the US controls the printing press. But printing more money doesn't solve the problem. It just shifts it. When governments print to pay their debts, it leads to inflation. Inflation erodes savings, weakens the dollar, and destroys trust in the system. And if trust is lost, the entire global financial structure built on U.S. treasuries begins to shake. Let's put this into perspective. Every household in America now effectively owes about $270,000 in national debt. Every taxpayer owes over $1 million. If the U.S. tried to pay down this debt, even by cutting spending and raising taxes drastically, it would take generations. The interest alone compounds so quickly that new borrowing is needed just to pay the old interest. It's a vicious cycle, the same one that crushed ancient empires, from Rome to Britain. Some call it the debt spiral. Once you enter it, there's no easy way out. You borrow to pay the interest grows, you borrow more, and eventually the system becomes unsustainable. Economists have a polite word for this: fiscal dominance. It means monetary policy. The central bank's decisions becomes controlled by government debt. Instead of fighting inflation, central banks are forced to keep interest rates low just to keep the government solvent. In simple terms, the debt gets so big, the country can no longer afford to fight inflation. That's the trap the United States is walking into. Right now, interest rates are hovering around 5%. If they rise even slightly higher, annual interest payments could hit $1.5 trillion. To cover that, the U.S. Treasury must issue more bonds, more IOUs to the world. But investors aren't infinite. At some point, someone asks, why should we keep lending money to a government that can balance its books? And when that question spreads, confidence breaks. That's how debt crises begin, not with default, but with doubt. We've seen it happen before: Greece in 2010, Argentina in 2014, the UK bond panic in 2022. Now imagine that happening not in a small country, but in the biggest economy on earth. A loss of confidence in U.S. debt would ripple through every financial market in the world. Bond yields would skyrocket, stock markets would crash, the dollar would fall, and every country tied to the U.S. financial system, which is basically everyone, would feel the pain. There's another piece of this puzzle: Social Security and Medicare. By 2033, these programs are projected to run out of money. That means the government will either have to cut benefits, raise taxes, or borrow even more. Politically, cutting benefits is suicide, and raising taxes is unpopular. So what's left? More debt. And that's why analysts call it a time bomb. Because at some point the math stops working. You can't keep borrowing forever when your interest payments exceed your income. And for the first time in modern history, America's interest bill is larger than its entire defense budget. That's a red flag no one can ignore. So, what happens next? There are a few possible scenarios. Scenario 1. The US continues down this path, printing money and issuing debt, hoping growth outpaces interest. That's the optimistic view, the idea that innovation, productivity, and GDP growth will eventually save the day. It's possible, but unlikely. Scenario 2. Inflation becomes the hidden tax that reduces the debt burden. Governments have used inflation for centuries to make their debts smaller in real terms. But that punishes savers, retirees, and anyone holding cash. It's theft through devaluation. Scenario 3. A financial reset, a major restructuring of debt, or a change in the global monetary order. That could mean the rise of digital currencies, gold-backed systems, or regional alternatives to the dollar. It sounds radical, but history says it's inevitable. Every dominant currency eventually loses its crown. The pound sterling ruled for over a century before the dollar took over after World War II. Now whispers of de-dollarization are growing louder from BRICS nations, from Asia, from oil producers. If global trade starts shifting away from the dollar, the US loses its magic trick, the ability to borrow endlessly because the world demands dollars. Already, we're seeing the first signs. China and Russia are trading energy in yuan. Saudi Arabia is considering selling oil in other currencies. Even developing nations are experimenting with digital payment systems that bypass the dollar entirely. Each of these is a small crack in the foundation of dollar dominance. One by one, they add up. For now, the US dollar remains strong, not because it's flawless, but because everything else looks weaker. The Eurozone is struggling, China's growth is slowing, and emerging markets are volatile. The dollar is still the cleanest dirty shirt in the laundry. But that doesn't mean it will stay that way forever. When trust erodes, change happens fast. And once global investors lose faith in US debt, it won't be gradual, it'll be a stampede. So what can be done? In theory, the solution is simple: spend less, tax more, and reform entitlement programs. In reality, it's politically impossible. No president wants to be remembered as the one who raised taxes or cut Social Security. No Congress wants to vote for austerity, so they kick the can down the road, and the road is running out. The Congressional Budget Office projects that by 2030, America's debt will reach $50 trillion. $50 trillion. That's not a typo. At that level, even small changes in interest rates could cause economic earthquakes. A 1% rise in rates could add hundreds of billions to annual interest payments. It's unsustainable. Meanwhile, younger generations are waking up to a harsh reality. They're inheriting a country living on borrowed time and borrowed money. Taxes will have to rise, benefits will have to shrink, and the American dream will look very different. Now, here's the part no one wants to admit. The US may never technically default, but it can default in disguise. It can pay back every dollar it owes, but those dollars might be worth far less. That's called a soft default, and it's already happening slowly. When inflation runs hotter than wages, when the cost of living rises faster than savings, the debt is being paid by you. The question isn't if the system changes, but when. Some experts believe the next decade will bring a monetary reset, possibly a new Bretton Woods-style agreement, where global currencies are rebalanced and the dollar loses its absolute dominance. Others think technology will play a role: digital central bank currencies, tokenized debt, blockchain-based settlements, whatever shape it takes. One thing is certain: $35 trillion doesn't vanish without consequences. For investors, that means staying alert. Debt crises don't announce themselves, they erupt suddenly when confidence cracks. Gold, silver, and commodities tend to rise in such times. The stock market may rally on stimulus, but beneath the surface, the real story will be the currency itself. A weaker dollar means imported inflation, higher costs, and global instability. History tells the same story over and over. Every empire builds its wealth on debt, then loses control of it. Rome abased its silver coins. France printed its assignats. Britain clung to the pound until it collapsed under war costs. And now it's America's turn to face the math. Debt is not just numbers on a screen. It's promises, promises to veterans, to seniors, to bondholders, to the world. And those promises are starting to collide with reality. You can borrow from the future for only so long before the future stops lending. The US may not fall tomorrow, or next year, or even this decade. But the seeds of the next financial crisis are already planted. $35 trillion is not just a statistic, it's the story of a superpower living beyond its means. And when the bill comes due, there won't be enough money in the world to pay it. The debt bomb is ticking. The question is not if it will explode, but who will be holding the dollar when it does.